Year 2015. Walgreens Boots Alliance was at its peak. After merging Walgreens with Alliance Boots, the company became a global pharmacy giant. Thousands of stores, prime American street corners, a dividend streak that had lasted for more than 4 decades. On paper, it looked unstoppable. But fast forward to 2026, and that same company is restructuring, closing stores, cutting costs, and fighting to stabilize after years of financial pressure. So what really happened to Walgreens? To understand the struggle, we have to go back. Walgreens was founded in 1901 in Chicago. For more than a century, it perfected a simple formula: be everywhere, fill prescriptions fast, sell everyday essentials, and build neighborhood trust. By the 2000s, Walgreens operated more than 9,000 US stores. It wasn't just a pharmacy, it was part of everyday American life. Then, the industry changed. Pharmacy reimbursement rates from insurers and pharmacy benefit managers began shrinking. That meant Walgreens made less money on every prescription filled. At the same time, operating costs kept rising. Labor, rent, inventory, security. Margins became thinner and thinner. Then came e-commerce. In 2018, Amazon entered the prescription delivery business through PillPack. Customers no longer had to drive to a store. They could order medication from their phones. Meanwhile, competitors like CVS Health expanded into insurance and integrated healthcare services, building vertically connected ecosystems. Walgreens faced a choice: stay a traditional retailer or reinvent itself. It chose reinvention. In 2020 and 2021, Walgreens invested billions into primary care through Village MD. The vision was bold: transform stores into healthcare destinations, put full-service clinics next to pharmacies, increase patient traffic, boost long-term revenue. But transformation is expensive, and timing matters. As interest rates rose and healthcare costs climbed, those investments began generating significant losses. In fiscal 2023, Walgreens reported a net loss of more than $5 billion, including major impairment charges tied to its healthcare investments. Its stock price fell sharply from its mid-2000s highs. In 2024, the company cut its dividend for the first time in decades to preserve cash. It also announced plans to close around 900 underperforming stores over a multi-year period, not because it was disappearing overnight, but because many locations were no longer profitable. This wasn't a sudden collapse, it was erosion. Fewer customers walking in for front-of-store retail, lower margins on prescriptions, high fixed costs that didn't shrink with revenue. Then came a historic shift. In 2025, Walgreens agreed to be taken private in a deal valued at roughly $10 billion, a fraction of its peak market value from years earlier. For a company that once exceeded $100 billion in valuation, the contrast was stark. That gap tells a story. Now, in 2026, Walgreens continues restructuring, reducing costs, adjusting its healthcare footprint, streamlining operations, trying to stabilize performance in a retail and healthcare environment that looks very different from a decade ago. So what is the real reason Walgreens is struggling? It isn't just theft. It isn't just Amazon. It isn't just inflation. The real reason is structural pressure. Walgreens built an empire on physical retail pharmacy, but healthcare economics changed. Retail shopping behavior changed. Competition evolved, and its attempt to pivot into full-scale healthcare required enormous capital at exactly the wrong time. Walgreens is not bankrupt. It is still operating thousands of stores, but it is under pressure. Closing weaker locations, reducing costs, trying to redefine its role in modern healthcare. And the biggest lesson from this story is simple: longevity is not immunity. Being 100 years old does not guarantee the next decade. Industries shift, margins compress, and even the most familiar brands can struggle when the foundation beneath them changes. Walgreens is not exploding. It is not vanishing overnight. It is adjusting under pressure, quietly. And whether it successfully reinvents itself or continues shrinking, will define the next chapter of one of America's oldest retail giants. If you found this breakdown valuable, subscribe for more real, fact-based business stories. And tell me in the comments, do you think Walgreens can successfully reinvent itself? Or is the traditional pharmacy model slowly fading away?